For lesson 2-3, our learning objective is to analyze transactions for operating a business into debit and credit parts. This is exactly what we did in 2-2, going through the 4 questions that we ask ourselves every transaction, and then recording using debits and credits. Specifically today, we're going to be analyzing owner's equity accounts. So remember the 4 accounts that are affected in owner's equity that we learned in chapter 1: expense, sales, investments, and withdrawals. So we're going to go through how those look using debit and credit parts. So our first one, we received cash from sales, but we have a few blanks to fill out on our note guide. It is sales that increases a business's worth. So our first blank there. The account is a branch off of owner's equity. Like we talked about in 2-2, we're going to have a lot more specific accounts now going forward. Instead of throwing all those 4 scenarios into owner's equity, we're going to break them down into more detailed accounts. So sales increases what a business is worth. Owner's equity has a normal credit balance. That's our second bullet. So that means sales has a normal credit balance as well. So let's go through our first transaction here talking about sales. So we have received cash from sales, $1,100. In chapter 1, we would have had cash and owner's equity. Now, question number 1, the 2 accounts that are affected, we now have cash and we have sales. So a special account dedicated just to sales. Okay, question number 2, how do we classify these? Cash is an asset. Sales affects owner's equity. So that's pretty simple. Left side of the accounting equation and the right side of the accounting equation. Question 3, what do we need to do? Well, cash, we received cash. So in chapter 1, we would have done plus 1,100. Now, in order to increase cash, we need to debit cash for 1,100. Owner's equity is on the right side of the accounting equation, so it increases on the right side. So we're going to credit sales. One thing to note is that sales can only be credited. Sales increases with a credit. You're never going to have negative sales or decreased sales. So sales can only be credited. So step 4, cash is debited, sales is credited. So that is what our transaction looks like when we have sales, different from chapter 1 because now we have a specific account specifically for sales. So on your note guide at this point, you should have filled out what are these 3 answers. 2 accounts would have been cash and sales. We want to increase cash and increase sales. So that means we need to debit cash and credit sales in order to increase it. Now we're going to move on to expenses. So right here, expenses reduce owner's equity. So it's an account is a branch off of owner's equity. So now we're being more specific. We reduced owner's equity with a debit. Okay, so the account has a normal debit balance. So our next transaction here, we paid cash for a communications bill. That would be an expense. Transaction shows a company paying cash for an expense. So this transaction, let's walk through the 4 questions. Paid cash for communications bill for cell phone and internet services, $80. So cash and our communications expense, those are our 2 accounts. Cash is an asset. Communications expense falls under owner's equity. So assets need to be decreased because we paid cash. Owner's equity needs to be decreased because we're losing value in the company. So how we need to record this transaction is we need to credit cash to decrease cash, and we need to debit our expense. So you're probably wondering, well, why is debit right here? It says that it's increased. Well, this is a little bit different. It's still a debit because owner's equity is decreased with a debit. But every time we have an expense, we are only going to debit them. We're only going to add more to our expenses. So it is a debit, and that will be a decrease to owner's equity, but it's increasing the expense account. So it's a little bit tricky, but if you just remember, you always credit sales and you always debit expenses. Okay. Our last transaction here, we're going to talk about withdrawals. So withdrawals, it says withdrawals on our guide, says withdrawals decrease owner's equity. This means they have a normal debit balance. So just like expenses, we're always going to debit withdrawals. So 2 accounts, we have Michael Delgado drawing. That's a new account specific for withdrawals. And we have cash. So drawing is always going to be debited. And I think of that because we have drawing with a D and debit. Okay, cash is an asset. Michael Delgado drawing is an owner's equity account. We lost cash, so we're decreasing cash, so assets is decreased. Owner's equity is also decreased because we're losing value in the company. So how this transaction looks, you always have to have a debit and you always have to have a credit. We're going to credit cash and debit drawing. So that is what a withdraw transaction looks like. At the bottom of your note guide, you could go through, and first thing I would do is label the left side as debit and the right side as credit. It doesn't matter what the account is. Left side's always a debit, right side's always a credit. Go through on all of those. And then you're going to label, you might need to look back at our slides, you're going to label the increase and the decrease, and then the normal balance. So sales, always you're going to credit. Drawing and expenses, you're always going to debit. So that makes that pretty easy. So that is 2-3. Be looking for the 2-3 work together to get more practice.